This year did not turn out the way it was supposed to. Reflation, Goldilocks. It was supposed to be the year of the dollar's downfall. But rather than fall down, the dollar's demise has been greatly exaggerated, even though Jay Powell and the Federal Reserve ended up cutting rates anyway. That was what everyone said. The Fed wasn't cutting. The Fed was aggressively hiking. It was going to maintain rates higher for longer. That's why the dollar was going up. But now that the Fed is cutting, the dollar's going up even more. But with that, there's a whole range of issues. A resurgent greenback doesn't happen on its own, and it sure isn't about the Federal Reserve one way or the other. When we look back and review this year, starting with the dollar in mind, it all starts to make a lot of sense. What happened in 2024 fills in that gap which is left by the mainstream constantly trying to make everything about the Fed. There were a number of shocks and surprises which not only back up the dollar's direction, they point to a whole lot to pay attention to heading into 2025. In fact, it all leaves us with one inescapable conclusion, the same one that King Dollar has been trying to communicate all year. We may have begun 2024 with a mainstream filled with no landing scenarios, higher for longer, and most of all, reflation trades. 2024 was going to be the year of Goldilocks. Instead, we close it out with currency crisis around the world, banks in China on the edge, bonds and swaps and curves and uninversion, a possible AI bubble collapse in the stock market. Given everything that came up, especially in the second half of the year, and especially where it comes to the labor market, it more and more seems as though the dollar waylaid Goldilocks on her way and isn't going to let her appear here in 2025 either. But why is the dollar doing what it's doing? Well, it all goes along with what really happened this year, and that includes the rate cutting. Oh, the rate cutting. Lots of rate cuts from central banks, just as the markets were expecting. And those rate cuts are the other side of what's driving the dollar higher. And we can see that more clearly looking back at how this year actually progressed from one perspective to another. It all began early on this year with everybody talking about no landings and reflation trades. The idea was pretty simple. China had got itself in order. Stimulus at the end of 2023 had pushed the economy back on track. Europe was going to come out of its funk. The United States was going to be strong and resilient as ever. No questions about the labor market, nothing about unemployment. Here's what the IMF wrote earlier this year in January. Advanced economies are expected to see growth decline slightly in 2024 before rising in 2025, with a recovery in the euro area from low growth in 2023 and only a moderation of growth in the United States. Emerging market and developing economies are expected to experience stable growth through 24 and 25 with some regional differences. And comparing that to the October 2023 World Economic Outlook from the IMF, the forecast for 24 is about 0.2 of a percentage point higher, reflecting upgrades from China, all that stimulus. The United States, the unemployment problem was no problem, and large emerging market and developing economies. Nevertheless, the projection for global growth in 24 and 25 is below the historical annual average of 3.8%, reflecting, well, they're going to say restrictive monetary policies and then withdrawal of fiscal support because this is the IMF. So they're basically saying that the governments were allowing the economies to normalize and they would slow down a little bit, gently gliding into that Goldilocks soft landing. Central banks were supposed to just a few rate cuts, maybe in the second half of the year, as consumer prices rates went down, and they didn't need their policy rates to be what they claim is so restrictive. Everything was working real well. Let the consumer price rates go down, let interest rates normalize, and everything would be just fine. A few rate cuts just at the end just to seal it all off with one final beautiful flourish. And instead, when you look and review the central banks in the history of this year, it didn't go that way at all, including the Federal Reserve. While the Federal Reserve did not cut until September, holding off as long as possible, they definitely would have in July had they seen what was coming. Instead, you just look back at the dots, the projections from the Federal Reserve. Go back to last September, as I did in a video I put out on Twitter. They were thinking for 2024, the median dot in 2023, September 23 was 5.1% for the federal funds rate. So that was down maybe about a 1/4 point rate cut. But then December, they got it down to 4.6%. It moved back up in June to 5.1% and then 4.4%. 2025, next year, they were thinking 3.9% back in September. Again, that's the higher for longer. They dropped that down to 3.6% in December, 4.1% in June, back to 3.4% in September, and now 3.9%, right where it was back in September. So basically, the Federal Reserve cut rates faster than they expected this year, and now we're trying to say they're not going to cut as fast next year. And that's really that's the theme that we keep coming back to. Central banks starting out saying we're not going to cut all that fast because we don't feel we need to, and then realizing, holy crap, we need to speed it up here. So while the Fed right now is on the upswing as far as its dots and its expectation for interest rates, that's not likely to hold, especially when you look around at all the other central banks already doing what the Fed is likely to follow with. We look back at the ECB, for example. Last December, at its policy meeting, Reuters wrote the following. The European Central Bank pushed back against bets on imminent cuts to interest rates on Thursday by reaffirming that borrowing costs would remain at record highs despite lower inflation expectations. Laser focused on fighting the most severe bout of inflation in a generation, the Eurozone Central Bank left borrowing costs unchanged and did not even hint at a possible reduction. And so the ECB started out saying, we will not stop with our high restrictive interest rates until consumer prices are defeated. And then by June, they were already cutting rates even as consumer prices were still above their target. And they even then, when they started cutting in June, the idea was that they would do so once every other meeting in the same manner as the IMF laid out in its WEO for January. Just a gentle few rate cuts just to make sure that everything goes smoothly into the Goldilocks soft landing. But that quickly became September, followed by the next meeting, followed by the next meeting. By the end of this year, the ECB was debating about whether or not they should do a 50 basis point rate cut. And that's the thing we keep coming back to central banks. As I said, they start out thinking we're only going to do a few just in case. And as things change, as the outlook worsens, they forget all about the plan. They start accelerating to the downside. It's not just the ECB. We've seen the same thing. The Swiss National Bank. The Swiss started out this year. They were the first major central bank to cut way back in March, which was a shock to everyone. And like the ECB, the Swiss were not expected to cut every meeting, but they ended up cutting every meeting. In fact, they finished up the year with a 50 basis point rate cut in December, accelerating their plans because in Switzerland in particular, they not only see disinflation in consumer prices, they're now thinking that Switzerland is at risk because of global factors of experiencing maybe outright deflation in early 2025. Conditions have worsened. Consumer prices have changed, they unexpectedly changed, but in the other direction, not accelerating higher, accelerating lower. Undershooting. That's the theme from central banks all around the world as we enter 2025. And that was not supposed to be the case. Disinflation was supposed to be nice and easy and gentle, not holy crap, are we going to see negative numbers? That's where we get in Canada. Back in last December, Canada was the same as all the other central banks, more focused on consumer prices. In fact, the Bank of Canada said, the Governing Council is still concerned about risks to the outlook for inflation and remains prepared to raise the policy rate further if needed. The Governing Council wants to see further and sustained easing in core inflation and continues to focus on the balance between demand and supply in the economy, inflation expectations, wage growth, corporate pricing behavior, on and on and on, all prices, prices, prices. And by the end of this year, a full year later, what is the Bank of Canada thinking? Nothing about prices, everything about unemployment. Not only did the Bank of Canada start cutting rates and doing so at every meeting, they've now done 2 50 basis point rate cuts in a row. Again, the persistent theme. Something happened in the middle of the year that took Goldilocks off the table and started, scaring the pants off of these central bankers, getting some of them into 50s, others talking about 50s, while the Jay Powell and the FOMC are off in their own dots chasing CPI rates on a monthly basis. There are a couple others, the People's Bank of China, I'll talk about them in a moment, going from The Politburo directing them from a prudent policy to moderately loose, but that's the same theme as we're getting here. The Bank of England. The Bank of England has been among the more hawkish of central banks, but even they are starting to change. Bank of England didn't cut rates until August, and then it was a split vote, 5-4, over a 25 basis point rate cut, with 4 dissenting from the cuts, wanting to do nothing. They did another cut in between, and then in December, there was a 6-3 vote for a hold on interest rates, so not cutting in December, but now there's 3 dissenters wanting another rate cut. So even the Bank of England is shifting to that side too. And the Bank of Japan is the one outlier that's trying to hike rates, which plays into the US dollar, but not in the way most people think. As far as interest rates go in the marketplace, what we've seen is that short-term rates have come way down because of central banks getting out of the way, less policy interference at the front end of the curve, while longer-term interest rates have been largely steady to even higher, at least from the end of last year to the end of this year, at least close enough to the end of this year. And the reason is because there was a massive bond rally toward the last couple months of 2023, and rates going down substantially before we even get to the end of the year. But rates were never as high as they were in the short term anyway. Ever since 2022, market rates have been resisting central banks and their idea of rate hikes as well as higher for longer. Longer-term bond yields have been saying rates are not going to stay higher for longer, and that part has turned out to be true. So even though rates are not going down presently and they're basically where they were last year, they've already proven to be correct in that yield curves and inverted curves going all the way back to 2022. Set aside the whole recession thing. What inverted yield curves actually mean is that the market expects rates are going to go lower in the future. And compared to where rates were in 2022 and where they would go in between, that's absolutely been the case. What that said was, in the context of 2022, in the pandemic and the supply shock, was that inflation was never at risk of breaking out and staying a major problem forever. It was going to be transitory. And therefore, the central banks reacting to consumer prices would likewise be transitory. So forget the idea of inversion and recession, or set that aside for now. What market rates and inversions were saying was nothing more that rates were going to normalize and go down. And by normalize, I mean normalize to the 2010s. That's the problem. And that's where we get into this question of recession. How do we transition from the early 2020s and all of the artificiality behind it to what the long-run future gets to be? And that's the transition in 2024 that we're on about here. That's what we're really looking into. Central banks that are increasingly worried about that transition because 2024 was supposed to have settled the matter. This was supposed to be Goldilocks. There was supposed to be long-run future here, not further questions about where things are going. I just want to mention that Eurodollar University, we're having our Christmas sale that's ongoing right now. It's only for the next week until January 1st, New Year's. It's actually more of an after Christmas New Year's sale. Here's your chance to get into the monetary and macro background behind everything, talking about in great detail more than we can get into here on YouTube. Got a tremendous deal for deep dive analysis, including Eurodollar University's AI, and a bundle where we get memberships and the daily briefing all thrown in together. Check out the details for our Christmas sale, after Christmas New Year's sale, at our website, eurodollar.university. As far as interest rates going down and staying there in the long run, interest rate swaps and swap spreads. Swap spreads have actually compressed even more, even though interest rates at the front end, which is what interest rate swaps are based on, have already started to go down and have gone down quite a bit. SOFR rates are down 100 basis points because the Fed has cut by 100 basis points. And despite the fact the Fed has done that, the swap market and increasingly negative spread says they're not even close to done. The swap market says as many questions as there were in 2023 about the interest rates staying up, there are even more of them even after central banks have started cutting, including the Federal Reserve. So swap spreads have compressed even more than they had been at the end of last year, especially at the longer end in the 30-year maturity, which means that not only rates are going to go down, they're more than likely to stay there. The dollar, though. The dollar is, I think, the biggest surprise out of all of them. The dollar was supposed to go down. The Fed was cutting rates. Everybody said the dollar was higher because the Fed was hiking rates. And not only was the Fed hiking rates, it was going to leave them higher for longer. And so the dollar was going to fall because the Fed was lowering rates. And while the Fed did lower rates, the dollar didn't fall, and there was no higher for longer. And you see the DXY, for example, last year ended up around 101. Closing in on the end of 2024, it's at 108. Against a lot of other currencies, this is where we really see the details behind everything I'm talking about here. CNY, for example. CNY ended up 2023 at 710 to the dollar. And here the People's Bank of China and Chinese authorities are struggling, just holding it at 730. Japan's yen, which was 141 to the dollar, which was already a low level last year, 158 currently, and that's with the Bank of Japan hiking rates and threatening to hike rates more, even as the Federal Reserve is cutting rates and is going to cut rates even further. So interest rates don't explain Japan's yen, they don't explain China's yuan. How about the euro? The euro ended last year at 111, and it begins this year at 104. That's $1.04 per euro versus $1.11 per euro last year. But where we're starting to see currencies in crisis, that's Brazil. I've mentioned that recently because the real is not only hitting record lows, it is looking incredibly weak, and for all the same reasons. India's rupee, something I just talked about yesterday. The rupee, another record low, even though the Reserve Bank of India is betting heavily against the dollar. At least they're trying to bet against the dollar. They're not really having much success. Not that that's a surprise. And the reason the dollar is higher is simple. It's not the Federal Reserve. It's not interest rates, except that lower interest rates among central banks and central bankers and lower short-term interest rates in the marketplace, they're all a reflection of economic weakness. Risk aversion, that's the other side of the US dollar rising. And the farther and faster the US dollar goes up, the worse you know it is. And that gets into everything from commodities as well as macroeconomic details. Commodities, OPEC. OPEC has cut its oil demand forecast for this year 5 straight times because the Goldilocks soft landing, no landing that everyone was expecting, OPEC was expecting more than everyone else, just never happened. Oil prices themselves, 71.65, that's WTI at the end of last year, is 70.30 right now. It's basically gone sideways when it was supposed to be moving higher, back toward what OPEC was hoping, $100 per barrel. Gasoline, which I think is a big one and I think deserves a video of its own, gasoline is supposed to be rising at this time of year due to seasonal factors. This year, unlike almost every other year, it's not. Gasoline prices in the U.S. wholesale to CME, $1.94 per gallon compared to $2.11 last year when it was heading higher for seasonal reasons. One other one I want to point out, the Baltic Dry, which also has seasonal factors. Despite them usually have seasonal weakness at this time of year, last year at the end of the year, the Baltic Dry Index was 2094. Now, some of that was China's resurgent demand, actual buying stuff and making things in the real economy. This year, though, despite the bigger bazooka, the Baltic Dry is 990 closing out 2024. So less than half of what it was last year and heading lower toward what looked to be maybe even the 2022 lows, which are very close to a record. And on the list goes. You look at, for example, the macroeconomic data. We'll finish it out there. The U.S. labor market was supposed to be the strength behind almost everything. China, yeah, questions. Europe, questions there. But we could always depend upon the U.S. and its labor market. Strong and resilient was the word up until July and August. And while the Fed has become less afraid of the labor market to close out 2024, as I've been pointing out more recently, there's every reason to be more concerned, not less. So compare how the U.S. labor market has gone through this year and what that sets us up for in 2025. It's every bit consistent with the rising U.S. dollar. For example, the 6-month average change in the establishment survey, start there with the establishment survey, the most charitable view of the labor market. The 6-month average to end last year was 213,000, and the 6-month average, not quite to end this year, only up through November, that's the latest data we have, down to 143. Big downshift, even the establishment survey. Private jobs went from 160,000 last year to 108,000 on average this year. That's really close to the danger zone. Again, that's wildly overstating the situation. The household survey level of employment has been consistently weak throughout. The 6-month average change last year was 30,000 at the end, and it's up through November this year, it's just 10,000. The unemployment rate. The official unemployment rate was 3.7% in December of 2023, and in November 2024, it's up half a percentage point to 4.2. And when you consider and factor labor force dropouts, of which there have been a lot over the last year, the adjusted unemployment rate ended last year at 4.2, and through November is 4.8. And the hiring rate in JOLTS, 5.8 million versus 5.3 million. And on we could go. The job finding rate from the CPS numbers, that has absolutely plunged. And we could go through any number of other examples. China was supposed to have started this year on the right foot, but it ends it not just on the back foot, but really backpedaling badly. The banking crisis there has gotten substantially worse. The bazooka in September didn't work. The more the Chinese government feels it has to do, the worse you know it is. And at the end of 2024, the Chinese government is trying to do a whole lot. At least it's trying to say it's doing a whole lot because they're moving in the wrong direction. Same for India, same for Brazil, same for Europe, even though GDP is better in Europe this year so far and consumer prices are lower. We've seen unemployment start to rise in Germany and France in particular, big jump in unemployment in France, India, Brazil, and on and on and on. So where Goldilocks was supposed to show up, soft landing, instead we leave 2024 with, at the very least, more questions than we were supposed to have in terms of answers. But the biggest surprise out of all of it, the US dollar. The Fed finally cut rates. The Fed was supposed to be the reason the dollar was strong before, and the Fed cuts rates and it gets stronger still. And so the excuse is because we have to blame the Fed. We have to attribute everything to some monetary policy from the FOMC. The excuse now is, well, they're not going to cut as fast as they thought in September, even though they're cutting faster than they thought last September. It doesn't make sense because the markets are all trying to say, and the dollar most of all, things are not moving in the right direction. They did not settled the matter in terms of reflation. Goldilocks did not show up in 2024. Like I said, she was mugged by King Dollar on the way. And now that the dollar is in charge, we see all of these problems that show up all over the rest of the world, not just in Brazil or India or China or Japan. You can go on, but also markets and interest rates and central banks that are cutting more aggressively. And why are they cutting more aggressively? Same reason the dollar is going up. And all of it is that inescapable conclusion. When you look back at what happened this year, it all points to the same thing, the downside of the supply shock. There is still more downside to come, and it is getting worse heading into next year. Part of getting worse into next year, as far as the U.S. labor market is concerned, is why is no one hiring? The latest numbers are just, well, they're in the video link below. As always, thank you very much for joining me. Check out Eurodollar University's Christmas sale. Huge thank you to Eurodollar University members and subscribers. And until next time, take care.